You are not in the market to be comfortable. You are in it to be right. And in a panic, being right means only one thing: survival. The man who survives the storm is the one who profits from the calm that follows. The man who fights the hurricane is washed away with the fools. Your goal during a market collapse is not to make a fortune. It is to keep the one you have. Profit is the byproduct of not being wiped out when everyone else is. Forget the stories you have been told about buying when there is blood in the streets. Most men who try that simply end up adding their own. There is a precise moment to act, and it is almost never when you first feel the urge. Acting a day too early can be just as fatal as acting a year too late. The panic is a test of character, and the market grades you not on your intelligence or your courage, but on your discipline. The great panics do not materialize from a clear blue sky. They are the fever that breaks after a long illness. The sickness in the market leading up to the panic of 1907 was plain to see for anyone who was looking at the facts instead of listening to their hopes. The fact was that money was tight, dangerously tight. The cost of borrowing money overnight, what we called call money, was behaving like a wild horse. For months it would spike to alarming levels, 25, 50, even 100%. Think of what that means in your modern world. It is the lifeblood of the market, the credit that finances every major operation, suddenly becoming so scarce that its price becomes absurd. It was a sign that the largest players were straining. The foundations were cracking, but the public, as always, was staring at the pretty paintings on the walls, mesmerized by the rising prices of their favorite stocks. They did not understand that the entire structure was about to collapse. The full account of this time is laid bare in the pages of my life, recorded in the book Reminiscences of a Stock Operator. The link in the description of this video is your map to understanding these events. Do not neglect your studies, for the lessons I paid for with my fortune and my sanity are recorded there for you. I was bearish, not because of a hunch or a tip, but because the tape told me to be. The ticker tape, your modern real-time price feed, does not lie. Men lie. Newspapers lie. Balance sheets can be made to lie. The tape tells the truth, and the truth it was telling in 1907 was that the market was sick. Stocks would attempt to rally on good news, only to falter and fall back. They would sink on no news at all. This is the ultimate sign of technical weakness. The path of least resistance was not upward. It required immense effort for the market to climb, and it fell of its own weight. I began to sell stocks short. I did not take a massive position all at once. That is the amateur's way, betting everything on one roll of the dice. I began by probing. I sold a few thousand shares of Union Pacific. I sold Anaconda. I tested the market's reaction. When the stocks did not rally against me, when they struggled to find buyers, my thesis was confirmed. The market itself was telling me I was on the right side. My small initial positions were my reconnaissance. They were my scouts sent into enemy territory, and they returned with the message that the opposing army was weak and disorganized. Only then did I begin to commit my main force. My conviction grew with every tick of the tape. As the summer wore on, the strain became unbearable. The San Francisco earthquake in 1906 had been a tremendous shock to the system, draining capital and insurance reserves from the east. Then came the failures. The Heinze Copper Corner collapsed. The Knickerbocker Trust Company, one of the largest in New York, shut its doors. That was the spark that lit the fuse. The public finally woke up. But they woke up not to the danger, but to the fear. And fear is blind. The selling began in earnest. It was not the calculated, intelligent selling of professionals who had seen the warnings. It was the desperate, chaotic dumping of assets by men who suddenly realized they were ruined. During the height of the panic, the ticker tape itself became a sign of the crisis. It was running minutes, sometimes hours, behind the actual transactions on the floor of the exchange. Imagine trying to trade today if your price screen was updating with prices from an hour ago. It was chaos. Rumors flew that the exchange would be closed. Brokerage firms, institutions that had stood for decades, were failing one by one. They were being destroyed not because they held bad stocks, but because they could not get cash. Their assets were sound, but they were not liquid. In a panic, the only asset that matters is cash. Everything else is just a promise, and in a panic, all promises are broken. My short positions were ballooning in value. The profits were astronomical. The temptation for any man would be to close them out and take the money. But that would have been a mistake. You do not sell short into a panic. You cover your shorts when the panic subsides. Selling into the panic is like trying to catch a single raindrop in a thunderstorm. The downward momentum is too powerful. The only logical play is to ride it out, or if you have the nerve, to press your advantage by selling into the weak, short-lived rallies that punctuate the collapse. The turning point came not from a chart pattern, but from a man. J. Pierpont Morgan. He was not a government official. He was a banker, but he was the lender of last resort. He represented the final reservoir of capital in the country. When he stepped in, gathering the other solvent bankers and creating a pool of money to lend to the struggling firms and to the stock market itself, the fundamental condition changed. The reason for the panic, the utter lack of credit, was being addressed. The disease was not cured, but the patient was receiving a life-saving transfusion. To remain short after Morgan intervened would have been to bet against the most powerful financial force in the world. It would have been to ignore the single most important change in the underlying conditions. My job was not to be a bear. My job was to be right. The moment the facts changed, I changed. I began to cover my shorts. I did not try to pick the absolute bottom tick. A man who tries to buy at the bottom and sell at the top is a fool. I began to buy back the tens of thousands of shares I had sold short. I was not timid. I gave my brokers orders to buy at the market. I needed to get out of my massive position, and the panic provided the liquidity to do so. The very people who were selling in terror, dumping their life savings onto the market at any price, were the ones who enabled me to close out one of the most profitable trades of my life. I walked away with over $1 million, a colossal sum at the time. I was now flat. I was in cash. I had survived. More than that, I had prospered immensely while the financial world was in ruins around me. But the greatest opportunity was yet to come. This is the part of the story that most people miss. They focus on the great short sale, the dramatic bet on collapse. But the true art of speculation is not just in profiting from the decline, but in recognizing the moment the decline is over. After I had covered my shorts, I did not go on vacation. I went back to my office and I watched the tape. I did nothing for days. This is the hardest discipline for a speculator to learn, the discipline of inaction. The market was still chaotic. It was trying to find its footing. There were violent rallies and terrifying sell-offs. It was a gambler's market, and I am not a gambler. I was waiting for the tape to give me a clear signal. I was waiting for the line of least resistance to declare itself. The signal I was looking for was not a headline in the paper saying, "Crisis over." It was a subtle change in the market's behavior. I would watch a leading stock, one that had been hammered down from 150 to 50. It would rally to 60. Then it would sell off back to 55. In the panic phase, a sell-off like that would have continued down to 45 or 40. But now it stopped at 55. The selling pressure would dry up. The volume would shrink on the decline. That was the tell, the exhaustion of the sellers. It meant that everyone who had been forced to sell, everyone who had been scared into selling, had already sold. The supply of stock hitting the market was dwindling. This is the first sign of a genuine bottom. It is not an explosion of buying. It is the cessation of panicked selling. Once I saw this behavior across several market leaders, I knew the time was near. But I still did not plunge in. I had to test my new thesis, just as I had tested my bearish thesis months before. My risk management demanded it. I gave my broker an order to buy 10,000 shares of a particular stock at the market. I did not haggle over the price. I wanted to see how the market would react to my order. If the market was still weak, a 10,000 share buy order would be absorbed with barely a ripple, or the stock might tick up 1/8 of a point and then fall right back down. But that is not what happened. The stock jumped a full point on my order. It was like striking a match in a room full of gas. The quick, sharp rise told me everything. It told me that there were very few shares for sale between the current price and the price a point higher. The sellers were gone. The path of least resistance had finally, definitively, turned upward. That was my signal for aggressive action. My period of patience was over. It was now a time for courage. I began buying with both hands, in size. I bought hundreds of thousands of shares of the market leaders. The stocks were still cheap by any historical measure, but that was not why I was buying them. I was buying them because the market itself had given me the signal that the selling was over and the buying had begun. I was not buying the dip, I was buying the turn. There is a world of difference between the two. One is an act of hope, the other is an act of calculated observation. In the days that followed, the market began a ferocious rally, one of the strongest rebound rallies in history. My new long positions became enormously profitable, nearly as profitable as my shorts had been. I had successfully profited from the entire cycle, the collapse and the recovery, because I did not get married to a single opinion. I listened to the market and I obeyed. From this experience, from the crucible of the 1907 panic, I forged the rules that have preserved my capital through every crisis since. These are not theories. They are laws, paid for in the currency of risk and loss. The first law is that survival is the only victory. Before you think about how much you can make, you must calculate, down to the penny, how much you can afford to lose. In a panic, this means your default position should be cash. Cash gives you options. It allows you to wait for the storm to pass and to act decisively when the moment is right. The man who is fully invested and clinging on for dear life has no options. He is a victim of the market's whims. Survival means you do not add to a losing position. It means you honor your stops, even when it hurts. In a crash, a 10% stop loss is not a suggestion. It is a commandment. It is the circuit breaker that prevents a manageable loss from becoming an irrecoverable disaster. The second law is to wait for exhaustion. Do not attempt to be a hero and buy into a cascade of selling. A falling price is evidence of overwhelming supply. To buy into it is to try and stop a landslide with your bare hands. You must wait for the evidence that the selling pressure has ceased. This evidence appears on the tape. It is low volume on declines. It is the failure of bad news to push a stock to a new low. It is a stock that, after a rally, gives back very little ground on the subsequent pullback. You are looking for the point of equilibrium where the last desperate seller has finally thrown in the towel. Only then is it safe to consider stepping in. The third law is to test the turn. Once you believe the selling is exhausted, you do not commit your entire fortune. You probe. You buy a fraction of your intended position. You treat it as an experiment. The market's reaction to your probe is your result. If the stock immediately goes against you, your timing is wrong. You exit the trade with a small, manageable loss. Your ego will be bruised, but your capital will be intact. If, however, the stock moves in your favor, and if your buying easily pushes the price higher, it confirms your thesis. It is the green light from the market itself, telling you that the path is clear. The fourth law is that when you are right, you must be right in size. After your test position has proven successful, you must act with courage. This is where the real money is made. The market has given you the signal. You have managed your initial risk. Now is the time to build your full position, pyramiding into the newfound strength. Timidity after you have been proven right is just as much of a financial sin as recklessness when you are wrong. The market pays you for being right, but it pays you exponentially for being right and being big. Finally, the ultimate law is to have no allegiance. You are not a bull, you are not a bear. You are a speculator, and your allegiance is to the truth of the tape. In 1907, I was the great bear of Wall Street. Days later, I was one of the market's biggest bulls. I changed because the conditions changed. To cling to a bearish outlook when J.P. Morgan himself was pumping money into the system would have been insanity. Your opinion is worthless. The market's opinion is the only one that pays. Learn to listen to it, and when it tells you that you are wrong or that the game has changed, you must have the discipline and the humility to obey instantly. That, and that alone, is how you manage risk during a panic. You do not manage it. You survive it first, and then you capitalize on the new reality it leaves behind.